Hey guys, hope you're doing well out there. Today I wanted to bring you guys a slightly different video taking a look at two retail heavyweights, namely Walmart and Target Corporation, and determining their fair values and seeing which one is trading at a better price today. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. So Walmart and Target both reported their earnings last week. Walmart up 10% year to date and up roughly 14% on a one-year basis, steadily outperforming Target stock, which is down 15% year to date and down 25% in the past 1 year. So taking a look at some comments made by analysts for these two companies, Walmart posted better than expected Q2 results with all segments showing comparable sales growth. Jefferies analyst believes that Walmart is positioned to continue to gain share due to its competitive pricing, convenient shopping, and dedicated customer experience. We know Walmart is a more affordable shopping experience compared to a Target, so as consumers tighten their wallets, Walmart is still the place to go for consumers in terms of their everyday shopping. Another analyst believes Walmart should be able to extend market share gains in Q3 as it remains focused on offering value to customers. Food and consumables will likely remain strong, but sequential improvement in general merchandise sales should still be down compared to last year. However, this sets the company up for a solid back-to-school season, and we know that's a big point of focus for Walmart. Target also posted better than feared Q2 results, featuring a notable jump in EPS and margins. Target executives also pointed an improved sales trend in July and August, which should be reflected on their next quarter. Analyst at Morgan Stanley sees the resilient margin performance suggests Target isn't getting more promotional spend despite top-line challenges, and sees a potential floor on margins that could be present regardless of the sales environment. Target also benefits from a solid supply chain and inventory management, but faces discretionary spending headwinds. Like we said earlier, Target is more discretionary than Walmart, as Walmart is more staple, so Target does see spending headwinds as consumers begin to tighten their wallets due to high inflation and interest rates. Looking ahead, there are still plenty of consumer headwinds in the mix, namely rising energy prices, resuming student loan payments, higher borrowing costs, and tightening lending standards. We know household budgets are still under pressure, and namely these are the consumers for a Walmart and Target. Moving on to the fair value calculations for each of these companies, I wanted to discuss some metrics, take a look at their balance sheet, and determine their fair value in today's standard to see whether these stocks are a buy today or not. Taking a look at the price to earnings metric, we see Walmart is trading at roughly 24 times forward earnings. Similar to a Costco, it trades at a premium in this space compared to a Target, which is trading at roughly 17 times next year's earnings. In terms of a price to sales, both of these companies trading relatively cheap on a price to sales metrics, both under 1. We do see Walmart is trading a bit higher at close to 0.7 times compared to Target, which is close to 0.6 times forward sales. In terms of operating cash flow, we see Walmart trading at roughly 13.9 times price to cash flow. Now this is operating cash flow, and so certainly this metric we would like to see under 10. For both of these companies. On Target, we see they are trading at a price to cash flow of roughly 8 times. So certainly a better deal on a price to cash flow basis than Walmart. Similarly, with the enterprise to EBITDA value, Walmart trading at a forward EV to EBITDA value of roughly 12.5 times compared to a Target, which is closer to 10. Similarly to price to cash flow, we want this metric to be under 10. Taking a look at the balance sheet metrics for both these companies, we can see they have a ton of debt compared to cash on their balance sheet. Walmart sitting at a roughly 0.2 times cash to debt ratio compared to a Target, which is closer to 0.1 times a cash to debt ratio. So certainly these companies have a ton of debt, which will take them a long time to pay off, and as interest rates rise, they will be accumulating more and more interest payments on that. Taking a look at their current ratio, which determines their current assets over their current liabilities, both these companies sitting at roughly 0.83 times. Ideally, we would like to see this over 1, which shows that a company can pay off all its current liabilities with its current ratios, over Walmart and Target sitting just under that at 0.83. Taking a look at their historic 5-year compounded growth rates, we see both these companies having mid-single digit growth rates, both on that top line and bottom line. Walmart having a 5-year CAGR of roughly 5% on that revenue side, whereas Target seeing a bit stronger growth on that revenue side, closer to 7% historically. On that EPS side, Walmart sitting at roughly 7% growth on a 5-year basis compared to a Target, which is closer to 5.6% growth on that bottom line. Taking a look at future projections for Walmart, they're expected to earn $17.5 billion of net income in fiscal year 2023. Analysts are projecting a roughly 10% 5-year compounded annual growth rate on that bottom line for the upcoming 5 years. This is higher than their previous 5 years, and so certainly if you believe Walmart can increase their profitability over the upcoming 5 years, 10% is that compounded annual growth rate. With that 10% CAGR, I took a price to earnings multiple of 15 times for the upcoming 5 years. Certainly it's cheaper than what Walmart is trading at currently, which is closer to 24 times. But I think in the future, Walmart won't be deserving a 24 times price to earnings, and so I took 15 as that multiple. They do have roughly 2.7 billion shares outstanding currently, and taking a share dilution of minus 2.5%, meaning Walmart expecting to buy back roughly 2.5% of their outstanding shares every year for the next 5 years. We do know they are doing a share buyback, and their share dilution over the past 5 years have been roughly somewhere between negative 1% to negative 3%. So taking that negative 2.5% share dilution seems reasonable. Applying a discount rate of 10.5%, so ideally we take a look at discount rates of 12% as that is market beating. However, since Walmart does pay a roughly 1.5% dividend yield, we take our discount rate of 10.5%, meaning we want to see Walmart return 10.5% every year for the next 5 years, and applying a margin of safety of 10%, we get to a fair value of roughly $97 per share. Walmart trading closer to $157 as of recording this video. That would represent close to a 35-36% drawdown from today's prices. Now, certainly if you are more bullish on Walmart, you can take higher estimates, and these estimates is really what will determine your fair value. And so if you believe a 10% CAGR annually deserves a 17 times forward multiple, that fair value would jump closer to 110. And so ultimately these estimates is what determines your fair value. And so in my opinion, I think being more conservative on that PE side and taking that discount rate to be 10.5% along with that 1.5% dividend, my fair value of Walmart is closer to $97 per share. Now, taking a look at Target, their projected net income for fiscal year 2023 is expected to be roughly $5.6 billion. Analysts have a 8% CAGR on this one for its bottom line for the next 5 years. That is also higher than its historic 5-year CAGR of closer to 5.6%. And so similarly to Walmart, analysts believe Target can pull levers on their bottom line to increase their profitability. Since it does have a slightly slower growth on that bottom line compared to Walmart, I'm taking a price to earnings multiple of 14 times rather than 15. They do have roughly 465 million shares outstanding, taking a negative 3% dilution, as Target has been buying back shares a bit faster than Walmart, roughly in that 3.5 to 2.5% every year. So I took a shared buyback of roughly 3% every year for the next 5 years. Taking a discount rate of roughly 8.5%, we know Target has a higher dividend yield, closer to 3.5%. So again, if we want the stock to return 12% annually for the next 5 years, we take a discount rate of 8.5%, since we have that 3.5% dividend yield, taking a margin of safety of roughly 10% again, we get to a fair value for Target at close to $110 per share. Now this one is trading roughly at 131 as of now, so that would represent close to a 15 to 16% downside in order to reach my fair value. And so ultimately, I think As of right now, neither of these stocks are trading at my fair value. However, Target is closer to that, as it only needs a roughly 15% drawdown to reach my fair value, and so certainly I'll have my eye on Target stock, and if it does reach my fair value, I would be more inclined to pick up shares of Target at that price. I will certainly be doing a deeper dive into Target if it does get near that $110 level. In terms of technical support, I do think there can be some technical support in that $110 to $120 range, as there has been some consolidation in Target stock at that price point. In terms of Walmart, I do think it is a bit richly valued right now, and I would be more interested in Walmart stock closer to this $9,900 range. That was a quick dive into Walmart and Target and determining my fair value for each of those companies. As always, thanks so much for listening, and I'll see you guys in the next video.